What's up, everybody? It's your boy Dave P with my main man RJ Pepino. We are the Cream. If you're new to our channel, Cream is for cash flow, real estate, and money. We are full-time real estate investors. We are buying properties every single day. We've built a portfolio of almost 600 units in our years of doing this, and we flip about 100 properties or more every single year. Our intention is to help you on your real estate journey, provide you tips, and we do have a Cream community. Check out the link below. RJ, how you feeling today, sir?
I'm feeling good. I'm really excited about the portfolio.
Yeah, as you should be. So we started buying our rentals in 2012. We're here in 2021 and going into 2022. Obviously, the market's been kind to us, but we weren't relying on the market being kind to us before we started owning real estate. There's many benefits of owning real estate. We're going to get into some of that today. We're going to also get into why right now is a tremendous time to buy real estate. But you know, the speculation, or I'm sorry, the increase in value of real estate, the appreciation that we've experienced in our own portfolio, that's all gravy. Even if our portfolio didn't appreciate over the years as it has, right? There's still many benefits of owning real estate, and we would still be buying it. We weren't counting on that appreciation to happen when we started buying, were we, RJ?
No, we weren't, because at that point in time, appreciation was like basically non-existent in Ohio. 2012, I was in the market here in 09 and 10 and 11, and then in 12, it started to pick up a little bit, but not to where it is now. The markets that we were in, yeah, there was a little bit more appreciation there, but it also came with a lot of maintenance. And we call those neighborhoods the C neighborhoods, you know, the C-class neighborhoods. We had to get a start there. We bought, what, 20 something properties. Gosh, man, 20 properties first year, getting down and dirty in the streets, posting notices, managing the freaking contractors, didn't really know what the hell we were doing. But we came out of it with a lot of lessons and, you know, almost $1 million worth of real estate. And that back then, the play is cash flow, and it's still cash flow play right now. And we are seeing the benefits and reaping the benefits of the appreciation that has happened since then. So it's like, yeah, we've always talked about, like, hey, sometimes you got to prune a few rentals, you know, just like a big old tree. Sometimes some of the leaves, you prune them so that the tree, actually the health of the tree or the portfolio is a lot healthier. And I'm really excited about what we're up to nowadays. So, you know, yesterday you were telling me about what came out in the news, which is really exciting. Why don't you touch on that?
Sure. So if you've been paying attention, today is the 11th, or, you know, the 12th of November, 2021. And it was actually, I believe, Wednesday that the CPI numbers came out. And if you're not familiar, CPI stands for Consumer Price Index. And that is basically the way they grade and measure inflation in our country. And that is what you're hearing everywhere. I mean, I pull up the Wall Street Journal, I subscribe to the Wall Street Journal. It's all over, you know, inflation. Everybody's talking about inflation. CNBC, Fox Business, Twitter, everything is talking about inflation right now, simply because, you know, they printed so much money, right? And this is what's going on right now, RJ. So it also, in the news, you hear a lot about you know, why, you know, there's shortages, or why prices supposedly are going up. They're calling it because of the supply chain shortages. They're talking about, have you seen in the news, RJ, they're saying, oh, all these ships are lined up on the coastlines and they can't get the stuff in here. Have you heard and kind of seen in the news that kind of stuff?
Yeah, I mean, I hear it on Bloomberg sometimes, and it's like, I imagine like these big ships can't come into the port because of you know, like issues with logistics. But thinking about it this way, it kind of makes sense. Like no one really, like, you know, we don't, as real estate investors, we're so much into the business that we don't think of it from a macro point of view. So it's interesting that you bring that up.
Well, here's the thing, and this is what they're not telling everybody. They're telling everybody it's because of these supply chain shortages, and that's the reason prices are up. I mean, we're feeling it at the, supermarket, and we're feeling it at the pump as well. But we're feeling it in the stores as well. There's shortages. I mean, the president of the United States just came out yesterday and said, "Oh, don't worry, there's going to be stuff on the shelves for Christmas." I mean, there's legitimate shortages right now. But this statistic, what I'm going to share with you, is what nobody's talking about, and they're not sharing this. We're actually importing right now more than ever before, historical high amount of merchandise. Well, how could that be? Right? How could we be importing more than ever before, and we're still experiencing these, what they're calling supply chain shortages? Well, get this. What they're not telling you is it's really not, the shortage of goods. I suppose it is, because we outsource everything to other countries. That's a problem in of itself. But the fact that they printed so much money and gave away so much money, free money, to businesses and to Americans, what that did is increase the demand for the supply. So when they give free money out to everybody, now you have this whole fleet of new buyers. Now everybody's a buyer for stuff. All these people who didn't have money before now have money, and where are they going? They're going to the store. They're buying, instead of maybe the, store brand, jelly and peanut butter. Now they're buying the Jif and the Welch's, right? Now they're like stepping their game up. Everybody has had an increase in the amount of money, simply because they printed it and they've given it out. And when there's this many new buyers, right, the supply starts to dwindle, and that's what we're experiencing right now. So, and that is why, inflation is happening. Another part of inflation, which we look at, pretty much monthly, is called the PPI, and that's the producer price index. So the producers' prices are going way up because commodities have gone way up, because the demand has gone way up. So the producers have to produce more. So the commodities that they are purchasing to build their materials and to construct what they do, are in more demand. So everything has gone up simply because the demand has gone up. And, for the producers, they held out for a while. The PPI has been surging, and it surged ahead of the CPI. So the producers' costs increased faster than the consumers' prices increased, because the producers held off, because they were promised by the Fed and by all the news and media, most of the Fed. They said, "Oh, this inflation, these price increases are temporary." The word they used was transitory. This is just transitory. That was the thing. So, the producer said, "Okay, fine, we'll eat the costs a little bit here. Our costs have gone up. We're not going to pass it on to the consumer." But then guess what happened? It ain't transitory, it's permanent. So now these costs, they have no choice, or there's no margin. They gotta pass the price increases, pass these costs onto the consumer. That's what we're feeling right now. And there's way more buyers than ever before. And that is creating shortages, that's creating price increases. And that's what we're dealing with. So that's what's happening in the world. But how does this affect real estate? And this is what we wanted to get into. So real estate is a tremendous, what they call a hedge against inflation. And think about, when you hear the word hedge, what comes to mind? Well, think about a castle. A castle has hedges, or, it has typically a moat, around the castle. But then the next line of defense, if you look at these old castles, was these giant hedges. Hedge is protection. So how do we protect ourselves from price increases and the increase of cost of living? Well, we need to own assets. And inflationary times help out people who own assets, because guess what? It also inflates or increases in price. It's the assets that we own. But what we like about real estate is not only does the asset itself increase in price, but what else? What do we collect every single month from the residents that live in our houses, RJ?
It's rent. And it also, I mean, as that, prices of houses or buildings increase, I mean, that's appreciation, right? When we bought it at a certain price, we started buying this back in 2012. That the properties that we have in that portfolio, I mean, has increased north of 30%. In areas where we used to, you know, our old model, the all-in $25,000 model, man, that was a great model. You can't even find properties that are standing at that price, right? So
You can buy a lot.
yeah, so nowadays those properties are worth in the 150, and then you know they're pushing new records. I saw a house on the hilltop that sold for close to 200. You know, and I, you know, thank you for that rehabber that took the chance to put all those finishes in, because it just increases the values of all those properties that we owned in the once C neighborhood. Now it's kind of transitioning. So yes, rents go up, property values go up, and you and I, since we started, you know, buying and holding for the long term, we get to reap the benefits of that.
And
So, and
here's,
that's just one. That's just one. That's just one asset class. There's plenty of asset classes out there. A little bit more, you know, I guess those are a little bit more high risk. There's like a high risk in there, but we love the real estate play.
well, yes, there's other assets out there. We can talk about buying stocks and stock prices increase and collecting dividends and whatnot, but there's no other asset like real estate, and I'll tell you why. So when you own a piece of real estate, not only do you get to ride out the inflation, meaning the price of the asset goes up, but also the rents increase. And as the rents increase, that basically protects you from your cost of living. When your rents increase, your income is increasing, right? But the reason why real estate is special is we have the ability to go and a bank is willing to give us money at a super low interest rate to buy this asset. So we don't even need to use all of our own cash. We can't do that with stocks, right? I love the stock market. I follow the stock market every single day. They serve their purpose and you know and whatnot. There's stocks that could increase easily 10x and whatnot. That's, you know, you can't really get that in a short amount of time with real estate. But why real estate is better is we have the ability to use leverage. And leverage is low interest, long-term debt. That's reason number one. Reason number two is because we also are blessed. The tax code is written for real estate investors and written for the wealthy. And I got that quote from you, RJ. I love that quote because it's absolutely true. And we have the ability to do what is called accelerated depreciation, meaning we can write off losses from these rentals that are taking such great care of us. We write off losses from the rentals against our flipping income, which is very highly taxed money. You can't do that with stocks either, right? So real estate is the number one play. And we're partial to, RJ and I own numerous multifamily apartment buildings, but we're partial to, especially if you're just starting out, stick to the single family. Why? There's the most amount of supply out there. It's the easiest to get involved with, takes the least amount of capital to get involved with. And there's the most exit strategies with single family properties, right? And as RJ was mentioning, when you're building a portfolio, sometimes you run into cash crunches. And what do? You got to pair a couple off. You can't really, if you own a multifamily apartment building, you can't really pair off just a couple apartments. You would have to sell the whole asset, right? But if you own single families as rentals as well, and you get into a cash crunch, you can go ahead and sell some. But that is why real estate is the best. Number one, we could utilize the leverage. And number two is the tax benefits that real estate provides us. So RJ, maybe you can touch on you know what we're doing with some of these refinances. So like how we purchase these properties in their as-is condition, and then kind of where it goes from there, and walk them through like our normal type of deal. Yeah.
Yeah. The long-term play for long-term rentals, we do the BRRRR strategy, or a cash out refinance strategy, where we're buying a lot of distressed homes. We're picking up homes that need a little bit of work, cosmetic type of work, and we're going in and we're borrowing private capital to buy and renovate them. And if we can be all in to anywhere from We'd like to be at 70%, but 75% is the max, because when we go and once we buy it, renovate it, and rent it, right, long-term renter that will pay a premium for the rent because of the rehab that we're doing. Well, then let's just say the example is, you buy a house for it's worth 200K, you got a really good discount, you're buying it for 100. You have to be all into that house for 150,000, because you are going to take that asset after you have renovated it. Let's just say you're renovating it for 30K. You're going to a bank, they're going to come and give you a loan, but 75% of that loan to value, let's just say the appraisal came in at 200, great. Now they're going to give you a loan of 150,000, and then you're going to pay that. You can get that 150,000, and you're going to pay your lender, right? You got to pay your lender back because you borrowed 130. They're going to make some points and interest and stuff like that. So after it's all said and done, let's just say you paid them 10,000. You're all into that property for 140. The bank gives you the loan for 150. All right. So now you have a spread there. We call that the cash out refinance spread. That is it's not taxable income. It's just basically the margin from where you're all in to where the bank lent you. So it's a loan. Now you can put that in your reserves account, and now you have a long-term asset that you used none of your own money for. Okay. It's just like that real life Monopoly that Dave and I are playing, and we want you to play the game with us, because we're also doing this on a bigger level with multifamily. But you can do this as many times as you want. You have now a long-term asset that's probably netting you around 400 a month if you're doing the long-term play. We're doing this also on the short-term play. So the short-term play, Airbnbs, you can use these areas and zones of your wherever your neighborhood is, and instead of netting 400, you're netting close to $10,000 a month based on the property that you're choosing to do this Airbnb strategy. Now that's very powerful, because before, back in 2012, yeah, Airbnb was kind of getting there, right? Getting some traction, people were doing it, but not that many banks were willing to lend long-term on those assets because they're short-term. Well, now banks are. And so Dave and I are very bullish on looking at our current portfolio and seeing which ones fit in these zones, these like little pockets of Ohio. And we're doing the same thing that we're doing on the long-term rental play with the short-term rental play, but the net is substantial, 5 times, sometimes even 10 times what you would see on a long-term rental. So I just left actually one of our rentals and did a quick video. It was loud in there, people were working, but it's going to be a beautiful place. And it's going to be right in the pocket where you can literally walk to downtown or take a short Uber ride or a scooter. And there's so many amenities close by because that area is gentrified, and it's like becoming this new hip place. Well, if we were going to use the same strategy, the cash out refi strategy on a long-term rental, will probably net close to $800. But since this thing is a massive building, it's got 5 bedrooms, 2.5 baths. On a short-term play, we can get close to 180 to 200 a night. And even if we get that rented for just a low occupancy of 60%, you're still outperforming, right? You're still outperforming your long-term rental. So this is a new focus for us, but we have a lot of rentals that could be converted into that short-term rental play. And if you're watching this and you want to do the same thing, look into your own little small portfolio or big portfolio and do the same thing, you're gonna know that you don't need hundreds and thousands of properties to live a good life, to have financial freedom. And if you want that, you can accumulate more, whatever you want to do. But that is a big finding in our portfolio, that we can turn some of these into short-term rentals and net a lot more, increase our revenue per door. And I highly suggest you take a look at that. We use AirDNA to get analytics there. AirDNA has 12-month to 24-month type analytics for the particular pocket in that you're going to do with the Airbnb play. So definitely check that out. So I'm excited about this. We've actually got one in contract this week in a really hot part of Columbus that we're going to turn into an Airbnb. So that is the future. And that's what we're up to.
That was it perfectly explained. You know, we find these deals off market, we buy them with private money, private lenders, so we can act really quickly. This is what we teach people to do, everybody. We are having very successful workshops. Check us out at risewiththecream.com below. We're going to go way deep with you at our workshops and teach you exactly how to do this. But that RJ summarized it. So we buy these things as is with private lenders. Then we rehab the properties. We refinance the properties with a bank. When we do that refinance, typically we are able to put money in our pocket tax-free. Now we have a long-term low interest loan against this property, so our payments just got lowered. Now, what RJ actually just touched on would be the exit strategy to maximize the revenue this thing can produce. And here's another kicker, everybody. We live in a time right now where the leverage, we love real estate for what two reasons? Well, number one, we can use leverage. Number two is the tax benefits. But now we live in a time where we could get low interest on our loans and it is fixed for 30 years. It's your payment's never going to go up. But guess what is going up is this rent. And then if you adopt the strategy that RJ was just mentioning with the short-term rentals, you are maximizing this thing. It's like a rag that you're just squeezing the water out of these things. You are ripping it. You are doing a great job. This is what we're going to teach everybody how to do. So follow us. We would appreciate your support. Like the video if you found value. YouTube loves the algorithm. Hit the bell for notifications. Leave us comments below. Leave us questions below. We love getting in here and answering all of your questions. We truly appreciate the support. This has been a presentation from The Cream. It's your boy Dave P and RJ Pepino, and we will see you on the next video.